Hi friends, welcome to our channel. Many people think wealth creation is only for high income earners. But the truth is very different. Even small monthly investments can create huge wealth over time if you stay consistent and patient. This is the real power of SIP investing and mutual funds. In this video, we will understand how a simple monthly SIP of 7,000 rupee can turn into 1 crore rupees and more through long-term compounding. Let us first understand what SIP means. SIP or Systematic Investment Plan is a method where you invest a fixed amount every month into mutual funds. You do not need a large amount of money at once. You just need discipline and time. The biggest advantage of SIP is rupee cost averaging and compounding growth, which slowly builds a large investment corpus over years. Now let us assume a simple example. You start a SIP of 7,000 rupee per month. That means your yearly investment becomes 84,000 rupees. We assume an average annual return of 12%, which is common in long-term equity mutual funds. Some years returns may be higher, some years lower. But over long periods, 10 to 15% average return is realistic in mutual funds. In the first few years, growth looks slow. After 1 year, your total investment is small and returns are also limited. But even at this stage, your money has started working for you. You are building the foundation of long-term wealth. Most people stop here because they do not see big results immediately. But SIP is not for short-term gains. After 5 years, your investment grows steadily. You are now starting to see the effect of compounding. Your money is not just growing from your SIP, but also from previous returns. This is where your wealth-building journey begins to feel real. Even though inflation reduces value, your investment still grows faster than savings accounts or fixed deposits. After 10 years, the growth becomes very powerful. Your total investment may be around 8 lakh rupees, but the value of your portfolio can be almost double or more. This is the stage where compounding starts accelerating. Your returns begin to contribute more than your actual investment. This is the key turning point in SIP investing. After 15 years, the compounding effect becomes even stronger. Your investment continues every month, but your returns grow much faster. At this stage, your total wealth can become 3 times or more than your invested amount. This is where long-term investors start seeing real financial confidence and stability. After 20 years, SIP becomes extremely powerful. A simple 7,000 rupee monthly investment can grow into a corpus of around 70 lakh rupees or more depending on market conditions. At this stage, your investment is not just savings anymore. It becomes a wealth-building machine. Compounding starts working like a snowball that keeps getting bigger. After 23 years, something amazing happens. Your investment can cross 1 crore rupees. This is the power of consistency and long-term investing. Without any large capital, without high income, just with discipline, patience, and time, you can become a crorepati through SIP. This is why financial experts always recommend starting early. If you continue beyond 25 or 30 years, your wealth can grow even more, potentially reaching 1.5 crore rupees or even 2 crore rupees depending on returns. The longer you stay invested, the stronger compounding becomes. Time is the most powerful factor in wealth creation, not the amount of money you start with. However, it is important to understand taxes and charges. Mutual funds may include expense ratios, exit loads, and capital gains tax. Short-term gains are taxed higher, while long-term capital gains tax is lower. But even after taxes and inflation, SIP remains one of the most powerful tools for long-term wealth creation. The main lesson is simple. SIP is not about timing the market. It is about time in the market. Even a small amount like 7,000 rupee per month can change your financial future if you stay consistent for 20 to 25 years. If you found this video helpful, don't forget to like, share, and subscribe for more financial education content.